Hey everyone, and welcome back to the channel. Today, we're deep dive into the Singapore Real Estate Investment Trust, or S-REIT, sector. The market has been under immense pressure, with many prominent dividend-paying REITs currently trading at or near their 52-week lows. But the big question is, are these simply value traps, or do they represent genuine bargains poised for a rebound? If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. This downturn is largely due to the prevailing environment of elevated interest rates, which has driven a higher for longer narrative, impacting borrowing costs for REITs and dampening investor sentiment. However, there's a glimmer of hope. Major central banks are now contemplating rate cuts later in the year, a move that could significantly alleviate pressure and foster a more favorable investment environment. In fact, early signs of declining borrowing costs were already visible in Q1 earnings for some SREITs. Despite the financial headwinds, the fundamental underpinnings of Singapore's REITs generally remain sound, characterized by healthy occupancy rates and robust balance sheets. The broader Singapore real estate market itself is projected to show resilient growth, with a compound annual growth rate of nearly 6% anticipated between 2025 and 2033. This suggests that current low valuations might be more about market dynamics than deteriorating asset quality. In this video, we'll dissect 5 different REITs, examining their past performance, current financial health, and what the future might hold for each. First, Mapletree Industrial Trust, or MIT. Its unit price has fallen 14.3% year-to-date to $1.92, near its 52-week low of $1.83. It currently offers an attractive distribution yield of 7.03%. Financials. While DPU declined in FY 2023 and FY 2024 due to rising interest rates, the first 9 months of FY 2025 showed a slight DPU increase, signaling a potential reversal. Occupancy stands at 91.6%, and notably, its Singapore properties achieved an impressive 8.1% positive rental reversion. Why the decline? The decline is linked to full-year earnings falling short of analyst expectations, mainly due to a slightly lower overall portfolio occupancy, specifically in its North American data centers. Outlook. Analysts generally maintain a positive outlook, with a consensus target price suggesting a potential undervaluation of 21%. A significant driver for future growth is MIT's strategic acquisition of data centers in Tokyo and Osaka. Management is actively addressing US vacancies and undertaking capital recycling, like selling assets at an 8.4% premium. MIT's core operational resilience suggests strong underlying asset health despite DPU dips. Next, Frasers Logistics and Commercial Trust, or FLCT. Its unit price is down 11.8% year-to-date, nearing its 52-week low, but it offers a high distribution yield of 8.45%. Financials. While revenue and NPI grew, DPU experienced a sharp 13.8% year-on-year decline in 1H FY 2025. This was largely due to increased finance costs, challenges in its commercial portfolio, and adverse foreign exchange volatility. FLCT maintains a high 93.9% occupancy. Crucially, its logistics and industrial division boasts a very strong 33% positive rental reversion, though the commercial portfolio saw negative reversions. Why the decline? The DPU drop is directly linked to higher finance costs, commercial property challenges, and the weakening of the Australian dollar and euro against the Singapore dollar. Outlook. Analysts have a moderate by consensus, with a substantial upside potential of 51%. Its robust balance sheet and capacity for accretive acquisitions are key catalysts for re-rating. While its commercial assets have been a drag, the strong performance of its logistics and industrial segment provides resilience. Third, ESR-REIT. Its unit price has fallen 14.6% year-to-date, but it offers a notably high distribution yield of 9.42%. Financials. Gross revenue and NPI dipped in FY 2024, and DPU tumbled nearly 18%. This was due to divestments, lower capital gains, and an enlarged unit base from fundraising. Occupancy is healthy at 91.6%, with a positive rental reversion of 8.6% in 1Q 2025. However, its gearing increased to 43%, and its debt-to-equity ratio is high at 84.4%, with a lower interest coverage ratio of 2.6x. Why the decline? The decline is attributed to a downbeat performance in 2024, significant net loss, and concerns over unstable dividends and shareholder dilution. The high leverage is also a concern. Outlook. Analysts are in good agreement that stock price will rise by 41.6%, with earnings projected to grow by a substantial 62.28% per year. The manager's strategy focuses on asset enhancement initiatives and redevelopments to improve earnings quality. Anticipated interest cost declines are also a tailwind. However, its high leverage makes it highly sensitive to interest rate fluctuations, implying higher risk despite potential for growth. Our fourth REIT is Lendlease Global Commercial REIT, or SREIT. It has experienced a 15.2% year-to-date fall, near its 52-week low, and currently offers a distribution yield of 7.98%. Financials. Gross revenue and NPI decreased significantly in 1H FY 2025, leading to a DPU decline. This was largely due to the absence of supplementary rent from its Sky complex in Milan. Its Singapore retail portfolio showed strong performance with 99.5% occupancy and a 10.4% positive rental reversion. However, Building 3 in Milan had a significantly low occupancy of only 31%. Its gearing is 38%, and about 76% of borrowings are hedged to fixed rates, but its interest coverage ratio is low at 1.5 times. Why the decline? The DPU reduction is primarily linked to the absence of the Milan supplementary rent, higher finance costs, and slow backfilling at the Milan property. Outlook. Analysts have a buy recommendation, suggesting an upside potential of 34%. SREIT is focused on improving its ICR through active asset management and capital recycling. Positive developments include new tenants and ongoing refurbishment works. Its proactive debt management, including refinancing at lower coupon rates, is a key strength that helps mitigate financial risk. Finally, CDL Hospitality Trusts, or CDLHT. Its unit price is down 13.2% year-to-date, offering a distribution yield of 6.86%. Financials. Total revenue and NPI dipped in 1Q 2025, and DPU fell in FY 2024 due to increased interest costs and the absence of one-off liquidation proceeds. Singapore's average occupancy fell to 75%, and revenue per available room, or RevPAR, tumbled nearly 16% in 1Q 2025. Its gearing increased to 41.8% in 1Q 2025, remaining within limits, but some reports show a very high annual DPU payout ratio of 496.3% for 2024. Why the decline? The decline is attributed to lower RevPAR in core markets, currency depreciation in overseas markets, and operational disruptions from ongoing asset enhancement initiatives, or AEIs. Outlook. Analysts generally have a positive outlook, with an upside potential of 41.8%. The trust is bolstered by contributions from recent acquisitions, prudent capital management, and declining borrowing costs. DPU growth is forecasted for the coming years. However, its short-term operational underperformance is partly due to temporary renovation works. Its global diversification also exposes it to foreign exchange volatility. So, are these REITs value traps or bargains? The distinction is crucial. REITs that maintain healthy occupancy rates, consistently achieve positive rental reversion in core segments, and are actively engaged in proactive asset management are more likely to represent bargains. They possess strong underlying asset health despite temporary DPU pressures. Conversely, those with persistent operational weaknesses, unsustainable leverage, or unstable distribution histories may pose higher risks. The outlook for SREITs is showing signs of improvement, largely driven by evolving interest rate expectations and resilient underlying real estate fundamentals. Falling interest rates directly translate to lower borrowing costs, a critical tailwind. Many REIT managers are actively pursuing asset enhancement initiatives, strategic acquisitions, and capital recycling to optimize their portfolios and drive long-term DPU growth. However, macroeconomic risks persist. A global economic slowdown, escalating trade tensions, and foreign exchange volatility, especially for REITs with substantial overseas assets, could still pose headwinds. In conclusion, while the current market is challenging, a discerning approach that evaluates individual REITs based on their specific financial health, operational resilience, and strategic direction can uncover compelling investment opportunities. The anticipated easing of interest rate pressures, combined with the inherent strengths of the Singapore real estate market, positions several of these underperforming REITs for potential recovery. This information is provided informational purposes only and does not constitute investment advice. Investing in real estate involves inherent risks. Please conduct your own due diligence and consult a financial advisor before making any investment decisions. Like and subscribe our channel for more videos.